You'd be surprised how many business owners, freelancers, and even startup founders I meet who don't still fully understand how the 9% corporate tax in the UAE actually works. Some think it applies to every dirham they earn, others assume they're totally exempt just because they're small, and then there are those who are just hoping it'll go away. But here's the thing, it's here, it's live, and if you're doing business in Dubai or anywhere else in the UAE, you need to understand what this means for you in 2025. So in this video, I'm breaking it all down: who actually gets taxed, how the thresholds work, the common misconceptions floating around, and how this new law is affecting different types of businesses like freelancers, holding companies, and tech startups. This isn't going to be some boring tax seminar. I'm keeping it real, practical, and relevant for anyone operating in the UAE right now. And before we get started, I'm not a financial advisor, so if you require professional help on this, please seek financial advice. So let's get right into it. Let's start with the basics. Yes, the UAE officially introduced a 9% corporate tax, and yes, it's already in effect since 2023. But here's what most people still don't understand. The 9% rate doesn't kick in from Dirham 1. You're not paying tax on your entire revenue. It applies to net taxable income, which means profits after expenses and only once you cross a certain threshold. That set threshold as of now is 375,000 dirhams in net profit annually. So if your business earns, say, 1 million dirhams a year in revenue, but after all your allowable expenses like rent, salaries, advertising, you're left with 300,000 dirhams in profit, you pay nothing. But if your net profit is 400,000 dirhams, then 9% tax applies to the only 25,000 dirhams above the threshold. So your total corporate tax bill in that case would be 2,250 dirhams, and that's not exactly the end of the world. Now here's where a lot of confusion kicks in. People assume this applies to every single business no matter what, but that's not the case. For example, if you're an individual, say a freelancer or a sole proprietor, corporate tax only applies if your business income exceeds 1 million dirhams per year. So if you're freelancing under a permit or a sole establishment license holder and making less than that, you're completely exempt from corporate tax under the UAE's small business relief scheme. But once you go over 1 million dirhams, then yes, corporate tax starts to apply, but still only on your profits after expenses. Here, I'm using a lot of terminologies like expenses, revenue, profit, or net profit after expenses. So make sure that you study these words and know the differences between each one to have a better understanding of what I'm saying here. Now let's talk about free zones, because that's another area where people are totally lost. Free zone businesses can actually continue to enjoy 0% corporate tax, but only if they meet very specific conditions. They have to qualify as a qualifying free zone person, and that means they're either doing business only within the free zone or outside the UAE. The moment they start transacting with mainland clients or don't meet the detailed conditions set by the FTA, they risk losing that 0% status and being taxed at 9% just like everyone else. But now let's talk about the gray areas, because this is where most of the confusion kicks in, especially for freelancers, startups, and holding companies. Let's say you're a freelancer operating under a sole establishment or even just using a freelance permit in a free zone. If you're earning more than 1 million dirhams in business income per year, then yes, corporate tax becomes relevant. But if your setup is registered under a qualifying free zone, this is where it gets a little tricky. You might still be eligible for 0% tax depending on your activity and whether your income is considered qualifying income. Now, what is qualifying income? That's a whole debate in itself, but in a nutshell, it typically refers to income earned from doing business outside the UAE or within the same free zone and not with mainland entities. So if you're a freelancer with clients in Europe or the US and you're operating through a free zone company, you could still be in the clear. But the moment you start serving mainland clients, boom, that income may no longer be considered qualifying, and that's where the 9% tax could apply. For holding companies, the conversation shifts a bit. If you're running a structure where your UAE entity owns shares in other companies, property, or assets, you're probably wondering, do I need to file corporate tax returns? The short answer is yes. Every company is now required to register with the Federal Tax Authority and file returns even if they're earning zero or under the threshold. There's no skipping that. But whether or not you pay tax depends on whether the income is passive like dividends or active. Passive income like dividends from UAE-based companies is generally exempt. But if your holding company is actively trading, consulting, or providing any kind of service, you might fall under the 9%. Now for startups, especially in tech and digital industries, this corporate tax is actually more manageable than most people think. And you may ask why? Because most startups run at a loss or break even in their early stages. If you're still building, testing your products, or reinvesting all your revenue into product development and marketing, chances are you're not hitting that 375,000 dirham mark. And even if you are, expenses are deductible. So you might qualify for zero tax or a very small, tiny bill. That said, what you can't do anymore is just ignore the tax system. Whether you're profitable or not, you now need to register your business with the FTA. You need to keep proper books, file returns annually, and understand the difference between qualifying and non-qualifying income if you're in a free zone. Now let's bust another myth I keep hearing. People think that if you have multiple companies under your name, you can just split your income across them to avoid crossing the threshold. That's a no-go. The UAE corporate tax framework has specific rules around connected persons and grouping. If your entities are linked, whether by ownership, management, or even if you're just billing between them, the FTA can consolidate those for tax purposes. So don't try to game the system. It's not worth the risk, especially now that audits are becoming more and more common. So what should you actually be doing right now? First, make sure your company is registered with the Federal Tax Authority. This applies even if you're not earning enough to pay tax yet. Second, start maintaining proper bookkeeping. That means profit and loss statements, expense records, and clean documentation of your income sources. Third, get clarity on whether your free zone income qualifies for 0% or if you're liable for 9%. If you're unsure, speak to a qualified tax consultant. Again, don't speak to me, speak to a tax consultant. It's better to pay for proper advice now than deal with penalties later. From a broader perspective, this move isn't really a surprise. The UAE is aligning with global standards. The introduction of corporate tax was inevitable, especially with global pressure around fair taxation and the push for countries to stop being seen as tax havens. The good news is, even with this tax in place, the UAE remains one of the most business-friendly environments in the world. A 9% corporate tax is still among the lowest globally, and there's still no personal income tax, at least not yet. No capital gain tax and no withholding tax. But as with anything tax-related, the devil is in the details. And if you're operating in 2025 with your head in the sand, thinking I'm too small to worry about it, you could be setting yourself up for fines, missed deadlines, and worst of all, unintentional non-compliance. So whether you're a freelancer, solopreneur, investor, or scaling a business, you need to take this seriously. In my opinion, the UAE isn't trying to punish business owners. In fact, most small businesses still won't end up paying much tax, if any at all. But they're trying to formalize the system, track business activity more closely, and make sure everyone's operating on the same playing field. So if you play smart, stay organized, and get professional advice when needed, you'll be just fine. Now, time for final thoughts. Corporate tax in the UAE is a big shift, but it's not something to fear. It's just something to understand. And once you do, it becomes one more part of the game that you know how to navigate. So what do you think? Has corporate tax impacted your business yet, or are you still figuring it out? Drop your thoughts down in the comments below, and if you found this video helpful, hit the like button, subscribe, and hit that notification bell for more videos just like this one. I'll see you guys in the next one.